Alrighty, guys, thank you for coming back. Welcome to week 6 of the Market Information Lab Valuation Bootcamp. We'll be working on actually building out the DCF today. Hopefully, you guys have access to the Excel spreadsheet and can follow along at home. If at any point going too fast, feel free to pause, rewind the video, um, and if you have any questions, feel free to email the Market Lab team. Without further ado, we're going to go ahead and start building out some of the assumptions. We've looked at kind of building out a lot of these assumptions throughout our time using the Market Information Lab Valuation Bootcamp earlier throughout the semester. So we're just going to kind of start by going through and building out some of the income statements. So okay. So we're first going to start with revenue. Revenue is really important whenever we're actually, building this out. So we're going to start by taking revenue as a percent of growth. So we've done this multiple times throughout the boot camp, right? So year prior times 1 plus my growth rate. Going to copy and paste this across. So now I have revenue projections. So again, it's just the year prior times 1%, 1 plus my revenue growth rate. The way that this company has projected out, I think we're evaluating Chipotle. Chipotle has projected out restaurants and their costs. They have done costs as broken out by food and beverage, labor, occupancy. So we're going to continue to follow this format and base it off as a percent of revenue. So what we're going to do is we're going to take our food and beverage times our revenue, and we have percent of revenue down here at the bottom. Right, so copying and pasting this throughout. We're going to do the same thing for labor, and then occupancy, and our other costs to get us down to our gross margin. We're going to total these up, alt equals, again, sum, alt equals, and then we're going to copy this down, alt ESF. So now we should have all of our cost assumptions for Chipotle based off the revenue, restaurant operating costs, projected out based off our percent of revenue at the bottom. Our gross profit is going to be our revenue minus our operating costs, or cost of goods sold in this situation. So we're going to project that out, alt ESF. And then we also want to see how profitable Chipotle will be in the future based off our assumptions. So we're going to take our gross profit, we're going to calculate a margin. So margin is always the profit over some sort of revenue, right? So some sort of profit over revenue. So we are calculating like a 20% margin in the first year, and then we're expecting some increase in that margin based off historically, right? We think it's going to roughly end up about 21% gross margin. So we think that revenue will be, our cost of goods sold will be about right around 80% of our revenue. So now we're going to go ahead and calculate out the rest of our expenses to get down to our operating income, or EBIT. So we're going to see SG&A and other operating charges again as a percent of revenue highlighted at the bottom. So we're going to do the same thing. So revenue times my percentage down here at the bottom. So SG&A is 40, H40, and then we're also going to do the same thing, revenue times my other operating percent as a percent of revenue, right? So right around 1%. I'm going to copy these, paste this side. So nothing we haven't done so far in class. I'm going to total these, alt equals, copy, paste these across. And then again, I'm going to calculate, our expense as a percentage of revenue, operating expense margin. So that's going to be our operating expenses over our revenue. Copying this, pasting it to the side. So, we're starting to see a reversion back to some lower percentages that we have seen historically. Recently, it's been really high, so we think that we're going to slowly taper this down based off some, synergies, and no need to expand some of these companies, right? So based off our projections, we start to see that our operating expenses getting smaller throughout the period. So this should hopefully lead to an increase in operating margin. It's important to know what you're looking for whenever you're modeling. That way you know if what you're getting is actually correct, or maybe you might need to go back and adjust some things. So I'm expecting to see my operating margin increase throughout the period due to my operating expenses decreasing and my gross margin increasing. So if I don't see that, then I know I have a problem. So again, operating income is going to be my gross profit minus my operating expenses. And then I'm going to calculate a margin as my operating income, my EBIT over my revenue. And look at that. We're seeing a definite increase in margin, which is totally what we were looking for, we were expecting. So we're seeing about 9% increase in operating margin throughout the projected period. We're going to throw down a 0 for interest and other income. Interest and other income. Actually, we're actually going to leave this blank here, and we're going to link this to our supporting schedule later on throughout the class. So I'm just going to go ahead and change this to a highlight yellow. Usually when I model, highlight yellow means I still need to come back and do something, link something. So highlighted yellow because we need to link this later throughout the period. So I'm going to go ahead and unhighlight all of this orange because we have done all of this so far, no fill. I'm going to go ahead and calculate my pre-tax income. So this would be my operating income less any expenses or interest I have. Again, probably not, we'll link this in, but we want our model to be fully circular. We only need to make sure we change the interest. So when we come back to it, we'll just link that in, and all of our formulas should flow correctly. So copy and paste that down. Our income taxes, we're going to calculate as a percent of, we're going to take our tax rate and then we're going to multiply it by our pre-tax income, like so. And then we're going to calculate our profit and our margin. So our profit is going to be our pre-tax income less our taxes, and then again, our margin is going to be our income over our revenue. And copy these and drag these down. Again, I'm going to unhighlight these because there's no more work we need to do here. All of our formulas should be fully circulating. They're based off our assumptions here at the bottom. So if you have any changes in your assumptions, you can change them here. Again, that's also designated by the blue, like hard-coded number. Then only thing we have highlighted in yellow here is our interest and other income line. That's because we need to come back and plug in something here based off our projections. So I'll give you guys a second to catch up. Nothing here should be super new to you guys if you guys have been following along in the financial modeling bootcamp so far. I'm going to give you guys a couple more seconds to get caught up. If you need a little bit more time, feel free to pause the video. Moving on to the balance sheet. Balance sheet is definitely more tricky to set up since we need a lot of different linking here. So what I'm going to do is I'm going to flatline a lot of my assumptions here, and then I'm going to come back and link them as we fill out our supporting schedule. So I'm just going to do that right now. I'm going to flatline my cash. My cash will ultimately come from the cash flow statement, but I'm just going to flatline that here, Alt ESF, and then I'm going to highlight it into a nice yellow. I'm actually going to do that for all of these assets. So actually, I'm not going to highlight it. I'm just going to go ahead and flatline. Here. I'm going to sum up here. Again, I'm going to flatline here. Again, I'm going to flatline here. Flatline here. So these highlight in black. We're going to go ahead and unhighlight because there's no need for them. Right, we're just going to assume a flat line for our DCF. These green ones are numbers we need to go ahead and come back and adjust. So I've unhighlighted everything in black. The green is what we still need to link coming throughout. So we're going to alt equals, sum up all of these. So this may be somewhat confusing if you're doing this for the first time. What I'm doing here is I'm trying to set up my balance sheet. Basically, what I want to make sure is that my current assets and total assets is calculating correctly, and my current liabilities and everything is calculating correctly. That way, when I link in for my supporting schedules, it adds correctly and there's no changes that need to be made. Accounts payable, we're going to make all of these flat line. All these up. And you can see that we need to flatline because the pre-formatted green color means we need to link it in. Alt equals to sum these. And then I'm going to unhighlight this. It's black number. It means that we're just supposed to add here. Long-term debt is going to be equal to 0. Again, this is something that we will need to pull in from another statement since it's already highlighted in green. Same thing with rent is a flat line. We're just going to flatline it throughout the period. So I'm going to unhighlight this. Same thing with my deferred tax liability and other liabilities. So these are more complicated aspects of modeling that we're not going to really dive into in the financial modeling workshop. This may be something you actually have to end up calculating out on the job, but we really don't have enough time to go ahead and talk about modeling out all of these. So as you can see, I'm just summing all of these together. Right, so I'm setting up all my formulas. So all my formulas will calculate when I pull in the green numbers that I have flatlined. Common stock. We're not expecting a change in this, Alt F, right? So we're just expecting that to stay constant. Same thing with additional paid-in capital. We're not going to model in any changes in the equity capital structure, just the debt. Treasury stock. Again, we're just going to flatline this. Again, we're not modeling in any of these assumptions. You may do something like this if you are working at a bank, maybe working a little more closely with your client. And then our retained earnings is going to have an adjustment here in a second after we set up our cash flow statement. So I'm going to go ahead and unhighlight these because they are going to stay that way throughout the period. And then I'm going to add up my total liabilities and equity. Just like that. And then I'm going to go ahead and set up this check. I'm just going to copy and paste it from the right. Basically, what this check is going to show us, if our balance sheet doesn't balance, then we should have a problem. You always want your balance sheet to balance whenever you're modeling. And if something you've done doesn't balance, you always need to make sure you balance before you continue to do your model. It's very important that your balance sheet balances, or there's something wrong in your model. This is the easiest way to tell if there's something wrong in your model. There can be other things wrong in your model that you may just not know about, but this is usually the best way to tell. So we're going to go ahead and set up our cash flow statement. going to give you guys just a second here on the balance sheets to catch up if you have anything else left to catch up on. Again, we're going to pull in all of the green numbers from other parts of the supporting schedules, but feel free to get caught up. If you guys need a little bit more time, feel free to pause the video. Okay, so now we're going to go ahead and build out a cash flow statement. So a cash flow statement, we talked about this earlier in the class, but what we're going to do is go line by line, and we're going to plug in some of these changes. And then these changes are going to then be making this model fully circular, right? So the ending cash is a line item on our balance sheet, so we need to go ahead and calculate this number so we can have some adjustments, right? And then if we have a working cash flow statement, then our cash balance will fluctuate based on whether we're expending or using cash. So we're going to go ahead and start building this out with net income. So we actually have this number already calculated out. So I'm going to link it to my income statement here at the bottom. And since we're linking it to the bottom here, hopefully you understand why it was important. Go ahead and calculate the whole all the way down to net income and make sure that we at least set up our formulas to include interest expense. If we didn't include that, that means we'd have to go back and change some important numbers on our income statement as we begin to plug it in. So since you're using these numbers in multiple places throughout your model, it's important to make sure that it's fully circular and references what's in the model. Going to drag this across using the keyboard shortcuts that we worked on in the class. So the depreciation amortization is going to come from my PP&E or fixed asset schedule. So I'm going to go ahead and leave this blank. Same thing with my change in operating liabilities. So we're going to go ahead and calculate this in my change in net working capital or working capital schedule. And then other operating charges, I think we'll just go ahead and calculate this as 0 throughout the period. So we're not going to go ahead and calculate any of these. These are kind of unexpected operating charges that we aren't going to go ahead and calculate for today's purposes, but they may be adjustments. These seem to be one-time cash add-backs. See, these could be changes in deferred tax assets, things that we just aren't going to be calculating for today's class. So again, we're going to go ahead and set up our formulas as if we already linked in these numbers. That way we don't have to go back and change the formulas later. So I'm going to just sum all of the operating activities to get my cash from operating activities. Control C, Alt ESF, right? And so if you look at this, this is only the increase in net income that is available throughout the period because that's the only change we have from operating activities. I'm going to change the highlighting here since we have nothing left here. Purchase of PP&E and leasehold improvements. So this is like your CapEx or your leasehold improvements. We're going to go ahead and calculate this later in the fixed asset schedule. So we're going to leave this blank. Same with the sale. I think we're projecting a zero sales of or purchases sale of our investments. So since we're projecting 0, we're just going to flatline 0. Again, this is more a complex assumption. You really wouldn't assume any changes like this in DCF. Oops. And then we're going to unhighlight this since it's done, Alt equals, and we're going to set up our formulas to include CapEx once we plug it in. Last things we're going to do here, I think we're going to link in our changes in equity and issuances of debt and dividends. So I believe all of these numbers are green. Yep, they are. So that means they need to link in from other statements. We're going to set up our formula still regardless, Alt equals, and we're just going to sum up all 3 of these. Control C, Alt ESF. Right, so as we begin to pull in some of these changes, it will automatically update and adjust. Our beginning cash, this is a simple corkscrew. This is just equal to our ending cash. And then our increase or decrease in cash is equal to the sum of our cash from operating activities plus our sum from investing activities plus our sum from financing activities. And then we'll go ahead and add the total to get our ending cash. So now we have set up the cash flow statement. Here we have it completely linked, so there should be no required changes as we begin to link in some of these line items based off our supporting schedules. One thing I will do here before I continue on, I'm going to adjust my balance sheet to include net income and my new cash balances because of net income. Like I said, we always want to be making adjustments to the balance sheet and making sure that it always balances. So I'm going to do that by linking cash and cash equivalents to my cash flow statement here at the bottom, right? So my ending cash is from my cash flow statement, right? So this is what makes the model circular here, Alt ESF, pull all that in. And as you can see, I have an error here at the bottom. That is because I haven't adjusted my liabilities or equity to account for that net income increase. Simple fix here is I just want to take my prior year net income, so equals G38, plus we're going to link it to the net income of that year as so. Copy and follow that across Alt ESF. And I have an error somewhere. That seems to be calculating correctly. I don't know what's going on here. Oh, here's the problem. So I didn't set up this formula correctly, so I'm going to adjust it as so, and there we go, it all balances. So what happened was my formula here was messed up. It was just equal to the prior. You always need to make sure you're summing all of these. That way it fully links and balances. So unhighlight my cash and my retained earnings, simply because we should be done with the adjustments here for the most part. So now, our balance sheet is balancing, and we have a fully circular model that includes net income. So it's important to always be checking back to your balance sheet as you add in, supporting schedules, etc., to your cash flow statement and your balance sheet to make sure it balances. Okay, so now we're going to go ahead and start building out some of our working capital. So our working capital, pretty simple here. We're just going to go ahead and calculate out each of these line items. And as we calculate those line items, we can link them back to our balance sheet, and then we can also link them to our cash flow statement as the change. This change will then impact our cash balance, which should make the whole entire balance sheet bounce. So we're going to just pull in our revenue and cost of goods sold from our income statement. A simple grab here and a simple grab here. So that's our operating costs, total operating costs. And I'm going to copy and paste these down the row. And then I'm going to unhighlight these. And I'm going to remove our grid lines. So it looks nice and pretty. our current assets, so our current assets is mainly based off the revenue that we'll be calculating throughout the period. So we will be linking this to revenue, and we'll be using our assumption at the bottom, the days sales outstanding, to then calculate our accounts receivable. So essentially what we're saying is, how long does it take our revenue to go from accounts receivable to cash? How many days is our accounts receivable held in cash, or in accounts receivable, not cash? So that's looks like 4. So it takes 4 days for our customers to pay us. So what we're going to do is then do an adjustment based off the number of days, right? So what we're going to do here, is take our revenue, and we're going to divide it by 365, and then we're going the number of days in a year times our days sales outstanding to get our estimated accounts receivable. I'm going to copy this and paste it to the right. So now we have accounts receivable for the whole projection period. Same, we're going to do inventory. So inventory is more loosely based off cost of goods sold. So when we're modeling this, we're actually going to use cost of goods sold here. So we take cost of goods sold, divide it by 365, the number of days in a year, and we're going to multiply it by our days inventory held, which is 2. So this kind of shows us that the number of days that Chipotle usually has inventory on hand for is 2. So there's really high inventory turnover throughout the period, which is good to see if you're an investor. And basically what is happening is the business isn't holding on to that much inventory because they're cycling through it, which makes sense because most of what Chipotle sells tends to be, fresher goods. You wouldn't want to hold on to, meat or some fruits or vegetables for too long. So we went ahead and calculated our inventory based off our cost of goods sold and our days inventory held to go ahead and calculate these numbers. Prepaid expenses and other current assets is just a % of revenue. Again, just taking revenue and multiplying it by our assumption. We're going to copy these and paste to the right. Alt equals to sum these together to get our total current assets for the period. Total current assets for the period. I'll give you guys a moment here to get you guys caught up. Okay. Now we're going to go ahead and calculate our accounts payable, calculate accounts payable. So accounts payable is, again, more loosely based off cost of goods sold. How long does it take us to pay our creditors or our suppliers, whoever it may be? So we're going to take cost of goods sold, and we're going to divide it by 365 again, and multiply it by our days payable outstanding, right? So it takes about 9 days to pay off a payable. Copy those across. And then again, our accrued payroll liabilities and other current liabilities is based off of % of revenue. Revenue times my percentage. Revenue times my percentage. Copy these across and sum them up. I'm done with this. I'm going to unhighlight it and give you guys just a moment here to catch up. Just a moment here to catch up. Now we're going to go ahead and calculate our net working capital. So we talked about this earlier in the class, but net working capital is our current assets minus our current liabilities, less our cash and current portion of long-term debt. So both of these are not here in this schedule, so we don't need to adjust for them. So we got our new net working capital number, and then we are going to calculate the change, right? So as we see a net working capital increase, that means we need to expend cash to grow our business. So what happens is Net working capital, the change should be negative. Change should be negative. So I'm going to take prior minus current to get my negative change, right? Which shows I'm, again, spending cash to grow my business via current assets and current liabilities. Unhighlight this to show that I'm done. And now it's time to link them back into the cash flow statement and the balance sheet. So I'm actually going to go ahead and link first to the cash flow statement, and all I have to do is link the change and current assets and liabilities here. So if you see 104, so if you see, we're gonna go ahead and plug our negative number here. So equals my change right here at the bottom, 19.1. And I'm going to copy and paste these to the right, Alt-DSF, and then unhighlight to show that I have already linked it in. And as you can see, because it's already being added, it is adjusting out those numbers. Basically what it's saying is Chipotle is using cash to grow their current assets and liabilities, right? So this is not a bad thing. This is just how they're choosing to spend their cash. So if you go down, I can clearly see that my balance sheet doesn't balance, and that is because I haven't linked in my current assets and liabilities yet. So I'm going to do that just now. So accounts receivable is going to be equal to my accounts receivable number here. And then I'm going to just copy and paste here to pull all those numbers in. And then I'm going to calculate my account, go ahead and pull in my accounts payable and accrued payroll benefits here. And my balance sheet balances. So I'm going to give you guys some time to catch up here. Basically, all I'm doing is a simple linking to my schedule. Very simple, just linking it to my schedule. That way you can have a balanced balance sheet that is representative of your projection period, right? So has all these accounts growing or changing in value based off their prospective changes in value on the income statement. And then it is also being reflected in my cash flow statement, right? You're expending cash to grow the business, so that should reduce your cash. So again, it's always important to make sure your balance sheet balances as you start to build out these supporting schedules. If you guys need a little bit more time to go ahead and continue linking, feel free to pause the video. If not, we're going to go ahead and continue on here. So again, we're going to pull in our revenue at the top as we begin to calculate our fixed asset schedule. So revenue, again, is going to be pulled in from my income statement. Revenue is at the top. So we're pulling that in, right? So simple equals, and then we're just going to drag that across. And then our opening PP&E is a corkscrew, so that's going to equal our ending. Our opening is equal to our ending. Going to go ahead and drag that across. And then our ending is the summation of all of the changes. So that is going to be our opening minus our, or plus our CapEx minus our depreciation to get our ending. So I'm going to set up those values here. So then our CapEx is going to be based off a percent of revenue. So my percent of my revenue times my percentage. As you can see, this is cash being expended to grow my plant, property, and equipment. So it should equal, so it's used to grow my plant, property, and equipment. So it should be increasing my ending balance. And then our depreciation is the expenditure of this, right? So as you know, CapEx is the cash payment in the year, but the depreciation is the actual realization over the period. So my depreciation is based off a percent of PP&E times my percentage. right? So around 15% of my opening PP&E is going to be expended throughout the year. Common way to see this projected is also as a percent of revenue, whichever one is easier for you guys to go ahead and calculate. Here we're using as a percent of PP&E. This is all finished, so I'm going to unhighlight that and fix my grid lines. And there you go. You already have a fixed asset schedule. Very simple, not super complicated. We don't have any sale of fixed asset included here for simplicity. Pulled in the revenue. We have our CapEx increasing our PP&E, and then we have depreciation subtracting the value. So now we're going to go ahead and pull them back into their respective cash flow and balance sheet statements. So the first thing we're going to do is link depreciation into our cash flow statement. So equals depreciation. We're just going to grab this number here. One thing you want to be very aware of is whenever you pull something into a cash flow statement, you want to make sure that the signs are correct. So the signs are correct here because depreciation is a non-cash expense and should increase the cash from operating activities, right? So this is used to reduce your pre-tax income, but is added back because it's a non-cash expense in the period. Copying and pasting this to the right. Unhighlighting it because we are done with that part. And if you control page up, you can see our balance sheet is all out of balance. We will come back to that. Next, we're going to include our CapEx. Now, this is, again, what I was talking about here. Our CapEx on the fixed asset schedule is all positive numbers. However, it needs to be negative here to be reflective of the actual cash impact, right? You're using cash to buy PP&E, so this is a negative on your cash flow statement. So equals negative, and then I'm going to link it to my CapEx. Right. So we're expending this much amount throughout the period in our PP&E to grow our PP&E, to grow our business, and it is a negative number because it's a cash expenditure, so it should decrease our cash. Alt-H-N to remove that highlight. As you can see, we're quickly filling out the cash flow statement and the balance sheet, so only a couple more adjustments here before we can actually calculate our implied value in DCF. So our goodwill is the last thing that kind of needs to change here, and that is equals to my ending PP&E, right? Your balance sheet is the snapshot at the end of the year, so equals ending. And as you can see, as I begin to pull this in, my balance sheet will balance. Alt-H-N to remove my highlight. And then looking at the bottom, balance sheet balances, I'm good to continue on with my next supporting schedule. I'm going to pause for a moment here if you need to pause the video. If not, we'll continue. Go ahead and pause here. If you are just a little bit behind, you pause the video. Awesome. Continuing on. So now we're just going to finish up with a debt and equity schedule. This is just so we can adjust for any changes on the debt and equity schedule as far as the balance sheet and the cash flow statement goes. So a lot of this is based off of our assumptions. So Chipotle currently has no debt on the balance sheet. What we're going to do is essentially give them some debt on the balance sheet for simplicity and also some ideal capital structure thought process. Also, they have a ton of free cash flow that they're able to pay off this debt. So this is, again, just more of a thought process and more of an assumption that we made on our end when I were building out this model. A lot of times you would probably not even project out any changes in debt and equity just because it's not super important for actually building out a DCF. So our debt opening is going to be equal to our closing. And then our debt closing is going to equal the summation of my debt opening plus my issuance or repayment. Again, you have nothing in here right now, So it should be all zeros. And then my debt issuance or repayment is just a simple assumption that we provided here at the bottom. So we're saying that in this year, 2019, we're going to issue debt and then we're going to pay it down throughout the period, $50 million each year after that. And then we're going to go ahead and unhighlight these rows to simplify that we are done with the calculations. And then we're going to go ahead and calculate our interest expense. So our interest expense is based off the average value in debt throughout the period. So as you can see, we started with 0 in debt, and then we ended with 500 million. Does it make sense to pay 500 million in interest throughout the period? No, because we didn't have it throughout the whole period. Again, we're just making the assumption that they got the debt evenly throughout the whole period. So that's why we're using the average. So equals average of the beginning and ending times my debt interest rate. And there we have it. We have our interest expense throughout the period. And as you can see, our interest expense grows after the second year, mainly because our beginning balance now is much greater than 0. And then we are going to go ahead and multiply that throughout the period. And as you can see, as we pay off debt, we slowly have a lower and lower interest expense throughout the period. Next, we're just going to grab a simple number here, so cash from operating and financing, and then that's going to be our cash available for a dividend. Cash available for a dividend. So I think there's a small error here. This should be cash from operating and cash from investing. Oops, if I can spell. Right, so this is just basically the cash available that we have left for a dividend. So again, we're just going to link this very simply. Cash from operating plus my cash from investing, right? So how much cash have I brought in, less how much cash have I already expended. So we just want to keep a good eye on how much cash we're using throughout the period before we make any adjustments on how much we actually want to give out in a dividend. So here we also have the issuance or repayment of equity plus the dividend payment. So we have zeros in the previous year. No dividends have been given out. So we're going to just link this, issuance / repayment equals 0, all DCF, and then our dividend payment is going to just be 25% of the cash available. All right, so we have this cash available. Why don't we pay out some dividends to our shareholders? Seems to make sense. Alt-H, N to remove my highlight, and we are done with kind of our debt and equity schedule here. Now we have a couple quick adjustments we need to make to the cash flow statement until we can actually move on to calculating the values for our discounted cash flow analysis. First thing we're going to do here is the purchase or issuance of equity. So I'm going to go ahead and link that to my equity schedule here. So this is 0. We are not issuing or repaying any equity. There we go. And then our issuance or purchase of debt, so repayment of debt, so that is equal to, again, I'm going to just link it here. So again, we want to be very careful of signs. So we got 500 in debt, that's a $500 increase in cash, and then the expenditure is negative, so this seems good to go in linking this in. And there we have it. So throughout the period, we spend 50 million in debt, repaying off the debt that we issued in 2019. Last thing we want to do is issue dividends. So again, this needs to be a negative number because it is not on our schedule, equals negative, and then my dividend payment. So copy this, F, and this is kind of, again, a negative number that we are using to expend, right? We're sending cash to our investors via dividend. This should lower our cash balance, so that's hence why it's a negative. So all these numbers are correct and are pulled in, Alt-H-H-N to unhighlight, and we have a fully completed cash flow statement. To control page up, and our balance sheet is in shambles. So we don't have any balancing. First thing I'm going to do here is link my long-term debt numbers. So again, your balance sheet is a snapshot at the end of each prospective year. So I'm going to go ahead and link my debt closing number, 500. There we go. Next, I'm going to go ahead and pull in my dividend payments. So I'm going to go ahead and add my dividend payments here. So F2 to edit, and then I'm going to control page down and grab. So F2 to edit, subtracting the cash I'm using for my dividend payments here. And the last thing we have to do, so this all balances, which is great. Last change we need to make is to my interest expense. I'm going to link this as a negative number. Link that right here. And this is just the expense I have throughout the period related to that issuance of debt throughout the period. So now my income statement is finished. My balance sheet is finished and balances. And then my cash flow statement is finished and balances. So that is kind of the process of going out and building some of these supporting schedules and the 3 statements in practice. Hopefully you guys were able to follow along. Feel free to pause, rewind the video if you weren't able to follow along. So we're going to go ahead and skip past kind of the relative valuation. You should have that already completed. And now we're going to go ahead and work on our actual DCF. So the first thing we want to do for our DCF is going to go ahead and calculate Chipotle's prospective shares outstanding and stock price, to go ahead and calculate our market cap, figure how much of our capital structure is debt, how much is equity, calculate our cost of debt, and using a tax rate after tax cost of debt. Then we have our cost of equity, risk-free rate of return, market risk premium, beta, cost of equity, right? So these are all the important components in weighted average cost of capital that you probably have gone over in your classes like Fin 221, that we should have gone over last week in our slides going over intrinsic valuation. So I've gone ahead and populated some of the actual current market data for Chipotle. So as you can see, we have the shares outstanding and our stock price. So based off today's recording, our stock price was $786.75 on the last close. So I'm going to then multiply the shares outstanding times the current stock price to get their current market capitalization. Their total debt that they have is $0, right? Like I said, Chipotle doesn't have any debt, which makes them significantly less risky of a business. Total equity is equal to the market cap, and then our percent of debt over our total capital structure is going to be 0%, and our total equity is going to be 100%. So this is somewhat uncommon for a business, but very common in some of these all company-owned restaurant businesses, right? So you see companies like Chick-fil-A and Chipotle have no debt on their balance sheet. Their cost of debt would be 5% based off just an assumption we made. And then the current tax rate is right around 25% after tax cost of debt. So this is going to be their tax, their cost of debt times 1 minus our tax rate The reason we do this is due to the tax shielding of the interest expense. Our cost of equity, we're going to just assume a risk-free rate of return of 3.5%, and then we're going to assume a market risk premium of 5.5%. These, again, are just assumptions. You can use whatever assumption you like. These are the ones we're using for today. So our cost of equity is going to be our risk-free rate plus our market risk premium times our beta, 7.35%, and then we're going to multiply our cost of equity times our percent of equity plus our percent of debt times our cost of debt. And as you can see, they have an extremely low WACC simply because they have a higher WACC than they could have if they had maybe some changes in the total debt and equity, right? So if you maybe lean a little bit more and have a little more debt, you may have a lower WACC for Chipotle, right? This low WACC makes them a relatively low risk of investment. I'm going to go ahead and unhighlight these and then get rid of my red lines. Now we're going to get into kind of the meat of our discounted cash flow analysis. So this is what we've kind of worked towards this whole time, trying to calculate the implied value of Chipotle based off of some of our critical assumptions. So one assumption we just need to go ahead and provide here is our tax rate. So we're just going to assume a tax rate of 25% throughout the period. Maybe you think that the tax rate is going to increase after the after this new tax bill has gone. So maybe towards the end, you'd maybe plug back in 35–40% like we've seen historically. Again, this is just the assumption we're using for today. Discount factor. So we're going to go ahead and calculate our free cash flow. So this is actually going to be unlevered free cash flow because we are starting at EBIT instead of net income, which we will use next week or the week after in our leverage buyout analysis. So first, we're going to link our EBIT from our assumptions earlier. So this shows why it was important to go ahead and build out that three-statement model. It makes building out your DCF so much easier because you're just going to simply link to the numbers you already calculated, whether it be from the supporting schedule or from your income statement. Control page up. I'm going to go ahead and grab my EBIT number for my projection period. And I'm going to copy and paste this to the right. So now that I have that filled in, I'm going to take out my taxes. So I'm going to take my EBIT times my tax rate. And then I'm going to add in my depreciation. So my depreciation is going to come from my fixed asset schedule right here. Copying and pasting this to the right. And then my change in net working capital is going to be, again, a negative number. And that's coming from my working capital schedule. And then I'm going to grab my capital expenditures, again, from my fixed asset schedule. Again, I'm just pulling in these numbers. I'm not really paying a whole lot of attention to the actual negative or positive because we want to follow the formula to the T, right? So that is my EBIT less my taxes plus my depreciation minus my change in CapEx minus my CapEx, right? So if I follow this to the T, I should get my cash flow. So again, EBIT minus my taxes plus my depreciation minus my change in CapEx, or change in net working capital, minus my CapEx. Okay, so actually for this example, we are actually going to, our change in capital is already negative, which means we're already spending cash to grow our business. So it's already reflecting that negative change. So we're actually going to pull this in as a positive number. And then I'm going to go ahead and fix it back here on my net working capital. I'm going to make this positive just so everything works correctly. I'm going to pull this in as a negative here. Sorry, just some adjustments to the model here on going live. So CapEx, so again, we're going to take our EBIT minus our taxes plus our depreciation minus our change in net working capital. Now it has been adjusted to based off how cash is actually flowing. Something super important that you definitely need to pay attention to when you're building out this model, minus my CapEx. Copying and pasting this to the right. And there we have it. We have our free cash flow for the period already calculated out here. Next, we're going to go ahead and calculate the present value, and then we're going to pull in the WACC to get a present value of free cash flow, right? So this calculation we can do in a couple different ways. I think we're going to use the XNPV function here. So we're going to go ahead and pull in our WACC from our calculation here off to the side, 7.35. And then we're going to XNPV equals XNPV. And then our rate, our values, and then our dates. And there we go. We have gone in, pulled in our numbers for the periods here, and we have a present value of free cash flow of 1,483.4. Actually, we're going to do a quick adjustment to how we're calculating this. Instead of using the XNPV function, we're just going to calculate the present value of free cash flow right below, and then sum it off to the right-hand side. Sorry about that, guys. What you're going to do is take 198 divided by parentheses 1 plus, I'm going to link to my WACC to the power of, and then I'm going to do one here. Sorry. I'm going to do this to the power of 2019 minus 2018, and I'm going to lock that using F4. Using F4, I'm going to log it, so basically it will always be subtracting my my projection period less my historical, right? So like basically what this is saying is like you're going to discount this 1 year because it is one period past 2018. The other number I need to make sure I lock is D15 because that's my WACC, and I'll always be referencing that, right? So now I have my formula H13, right? So my free cash flow divided by 1 plus my WACC. I'm going to take that to the power of H5 less G5. So I'm going to take that to the power of the difference in the number of years, right? So as you get to the end of the period, this should be to the power of 5, and then this is going to discount of 5 periods. I'm going to copy this formula and paste it to the right. So now I have a present value of each of the prospective projection periods, and I'm going to sum these values here, so equals sum, just like that. and I should have my present value of free cash flow equal to $1,183,000,000. Cool. So I'm going to just give you guys a moment here to catch up. Let me know if you feel free to pause the video if you need a moment. Feel free to pause the video if you need a moment. If not, we're going to continue on. So my terminal year EBITDA. So now we're going to go ahead and calculate our exit assumptions. This ends up being roughly like 70% of your DCF, usually the value. So it's super important, and it's going to definitely increase our enterprise value. So what we're going to do is take our terminal year EBITDA. So that's my EBIT plus my D&A. So 811. I'm going to take my multiple 17 times, and I'm going to multiply them two together to get a terminal value, a prospective terminal value for this company. And then I'm going to take a present value of the terminal value. So same thing here, equals F24 divided by parentheses 1 plus my WACC to the power of, so your terminal value is at the end of 2013. So I'm going to do the same sort of calculation. So 2023, parentheses, 2023 less my 2018 number. So this should, and then again, give me 5, right? So I'm discounting it 5 periods. And that gives me an enterprise value of 10,859,000,000, 10,859,000,000. And then based off perpetuity method, I'm going to go ahead and grab my terminal year free cash flow, which is 354.6. I'm assuming a perpetuity growth rate of 3.5%. 3.5%. My terminal value is 355 divided by parentheses 7.4 less my perpetuity growth rate. So that's right around $9 billion. And I'm going to take the present value of this number here, same way I did earlier. So terminal value divided by 1 plus my WACC, parentheses, to the power of my ending period less my beginning period. And I think I need to change some parentheses here. Yep, add parentheses here to make sure that calculates correctly. So I'm getting a ending perpetuity growth rate value of 6 billion based on present value, and then when you sum up all those, the enterprise value is right around 7.63, right? So one thing we must note here is that this enterprise value is, significantly less than the current market cap and enterprise value of Chipotle. One of the reasons is because we were just using the median multiple for Chipotle. If we were to use its current multiple, roughly like 35 times EBITDA, you start to see an enterprise value that is much closer to its current market cap rate. So basically what you're saying is, what you're trying to see it when you're investing in Chipotle is, do you underwrite this multiple, right? So if you do not think that, it should be worth 35 times EBITDA, and that's, a choice between you and the rest of Wall Street on deciding how much a multiple it should be worth. This is what is really going to be driving the value here on Chipotle, right? Additionally, you may also want to look a little bit more heavily into the weighted average cost of capital for Chipotle. 7.4 may not be the right number. Maybe you might need to increase that or decrease that based off your perspective idea of like what you think the company should be worth, right? Go ahead and diving into this number more heavily could end up making a lot of changes on your DCF, right? So, but based off our DCF using median EBITDA multiple for your DCF, our analysis is heavily suggesting that Chipotle is severely overpriced, and it is tending to look much more like a growth stock than a restaurant stock in the prospective business. So, this kind of shows you how your ideas and your analysis really can point towards, an investment idea, right? So again, this is by no means investment advice, but if you were to build out this analysis and believe heavily in the assumptions you provided, then you would seriously think that Chipotle is overpriced and would not invest in the stock or possibly short the stock. Again, this is no investment advice. We have flatlined a lot of the assumptions and not as nearly as complicated of a model you need to begin to before you start looking at whether you should invest or not in Chipotle. However, this would be kind of the steps that you'd be taking. So this is how you would end up building out a DCF. Very long class just because we needed to build out the three-statement model for Chipotle. However, I hope you guys learned something. Hope you guys found this valuable and interesting. Next week, we'll be diving a little bit more into leverage buyout analysis. Thank you guys again for listening and following along. Hope to see you guys next week.